This is another classic example of the sort of academically driven policies that we've seen come out of the halls of central banking, which are no longer really populated by central bankers but by academics. The theory was fine, okay? The theory was kind of like how you launch an aircraft off an aircraft carrier. You jam the aircraft back at the back of the deck, you let it build up enough momentum and speed, and then eventually you let the elastic band go and the thing soars off into the bright blue yonder. That's great on paper, but it comes unfortunately with some consequences. Hello everyone, my name is Julian Brigden. I'm the co-founder of MI2 Partners and the co-producer along with Raoul of Macro Insiders. I'm here today because I think we're at a really important inflection point in markets. I think the big debate now, at least in the equity market and the supposition in the equity market, is that the central banks have once again pulled the rabbit out of the hat and successfully reflated the bull market, just like in a way that they did in early 2016. I think that's possible. I'm not sure that we're quite there yet. I think some of the assumptions that are being made are a little preemptive. And so I think there are some still risks. I think ultimately I'm pretty certain where the trend is going. But I think it's important at this juncture to sort of take a step back, look at how we ended up here potentially, and what are those markers that you need to be watching. I put some slides in the presentation, and the first one that I've stolen from the Fed is Janet Yellen's slide on optimal control from D-Day of 2012, so 6th of June. If you look at that slide, what you'll see is a sort of typical trajectory of where rates should have gone. And then you see a dotted green line that represents Janet Yellen's policy, which she referred to as optimal control. This is another classic example of the sort of academically driven policies that we've seen come out of the halls of central banking, which are no longer really populated by central bankers but by academics. And the theory was fine, okay? The theory was kind of like how you launch an aircraft off an aircraft carrier. You jam the aircraft back at the back of the deck, you let it build up enough momentum and speed, and then eventually you let the elastic band go and the thing soars off into the bright blue yonder. That's great on paper, but it comes unfortunately with some consequences. So if you look at the next slide, you'll see a slide that I actually stole from another Fed governor. This is Bostic's chart, which he talked about last September. And in that classic sort of central bank understatement, he said, "I've been thinking about the risks of running an economy too hot." So what did he mean by too hot? What he means is when you push unemployment well below NAIRU, which is the non-inflationary rate of unemployment. And if you look at this slide, you'll see that traditionally that hasn't ended well. It's almost always ended up with a recession. Very simply because you create one of two things. The first thing that you create is you create inflationary pressures, which forces the Fed to use his parlance to be overly muscular. And the second thing it does is you create misallocation of resources in the process of holding those rates super low. And as you try and normalize, or if some exogenous event comes along or shock comes along, the system tends to tip over. And the net result is, guess what? You end up in a recession. Well, we've already run this economy objectively too hot, right? We've pushed unemployment right back down to levels that we haven't really seen since the mid-60s. And you can see on this chart that while the Fed kept it going for a couple more years, it really didn't end well. It ended up with the massive recession we saw in the early 70s, late 60s, early 70s. So I think we're at a bit of an inflection point. That's where we are. The question is can they keep it going? So if we look at the two conditions that he set out for the necessity of a recession, have the Fed been too muscular, and or do we have excesses in the economy? If you look at the next chart here, you'll see a chart of Fed funds. And what you see is there's a nice downward sloping channel on Fed funds. And essentially we've come up and we've hit the top of that channel. Why is it downward sloping? Well, we keep accumulating more and more and more and more debt. So it takes a relatively lower level of rates to tip the whole system over. So objectively on paper, we're already at a level which you could argue is too muscular. The next chart I want to show you is excesses. And there are two areas where I can see some clear excesses. The first one is in the financial markets. And this chart shows you a chart of the MSCI indexes for the US versus the rest of the world, ex the US. And what you can see is US equity outperformance, the like of which we have essentially never seen before. We're at levels that surpass anything we've seen in the last 50 years on a relative basis. And there's sort of a couple of observations. Firstly, you can see that since the presidential election and the fiscal stimulus that we had and the talk of deregulation, the US market has surged. So if we go back to that idea is this similar to 2016? The answer is it could be, but we're a lot more extreme in the cycle. Those valuations and that extreme divergence are a lot more extreme than they were back then. And the second thing is it's very, very unusual to see financial markets really move this far or US equities outperform to this extent when the Fed's hiking. If you look at this chart, there's a little purple bar which shows, the last time that we had US equities outperform as the Fed hikes. This is massive outperformance as the Fed is hiked. So there really is, I think, arguably real excesses in the US equity market. And particularly when we talk to MI2 clients or macro insider clients, we've delved into some of those more, internal metrics to look at how we would see those divergences. When we look at some of those internal metrics, one of the ones I like to look at is look at some of the divergences we're seeing within the markets between growth and value stock sectors. We've had this big growth in the growth sectors, the names like sort of Amazons, the Ubers of the world, Netflix, Nvidia, these very rapid growth companies. Now, these companies, somewhat counterintuitively, grow in low growth environments, right? They grow because nothing else is growing. And they do that because they can get hold of super cheap cash. And they take that super cheap cash and they basically burn through it at a very rapid rate. We can see these companies losing billions of dollars a year, but they do it to generate revenue, and that's how stocks are valued. We saw this actually, ironically, exactly back in the 2000 dot-com period, where the same sort of companies were, stock analysts would argue, you can't look at them from an earnings perspective, you have to look at them from a growth perspective and a revenue growth perspective. And of course, that didn't end up very well at all. And actually, in fact, if you look at some of the ratios between growth and value, we've actually come right back to the tick, to the same levels that we saw in March of 2000 and in the summer of 2000. Of course, that didn't end up very well at all. So I think it's arguable that the Fed's policy, together with the fiscal stimulus of the Trump administration, has driven some of the internal metrics of the equity market back to dot-com highs, which is not good. But I think it goes beyond that, and I think that's where things get a little bit more problematic. Because if you think about the equity market, it's quite easy potentially for the Fed to do some QE. We could even have a trade deal with China and maybe push those PEs a little bit higher and those valuations a little bit higher. When it moves into the real economy, and particularly to one segment, it's not really about price. It's really more about affordability. We've pushed up prices of a lot of products now to pre-GFC highs. And yet incomes have not grown accordingly. And even now, a relatively small increase in rates has destroyed affordability. So if you look at this next slide, what you'll see is new home and existing home prices. And you can see that both of them are well above, in particular new home, their GFC highs. Now, some note of caution, we don't build the same types of new homes now that we built heading into the GFC. There are no affordable two-bedroom apartments, as everyone, certainly in this New York area knows, and probably pretty much around the country. Every new two-bedroom apartment now is luxury with all the bells and whistles, and that makes it the median price a lot more expensive. But the point is affordability is poor. So yes, there are many of you perhaps who are watching here who want to move out of mum's apartment or basement, but you can't afford to. And so if you look at this next slide, what you'll see is a metric for existing home affordability. And when you take income into account, when you take deposits into account, and you stress it even with a small amount of rate hikes in absolute terms that we've seen, affordability just imploded at the end of last year. This is a lot tougher metric to solve. Now, we've seen some improvement as this graph has bounced in affordability, as rates have come down a little bit. But you're going to have to get rates a hell of a lot lower to get them close to where affordability was back in, say, 2015 or 2016. How do you do that? Well, you could crash the equity market. Well, I suspect there wouldn't be that many people buying homes if you crash the equity market. You could raise wages. I think that's ultimately where the policymakers want to go. But that has implications too, potentially for inflation and potentially for rates. So this affordability metric, which is a lot more extreme than it was in 2016. Houses were, at their peak of affordability almost in 2016, is another thing that makes me question this automatic assumption that it's game on 2016 redux. So the end result, I just want to show you one more slide on this, is that if we look at our growth metrics, unlike 2016, where growth was basing at the beginning of the year. So as Janet Yellen turned super dovish post the Chinese devaluation, the pseudo-emerging market crisis that we had at the end of 2015, she turns dovish and at the same time growth picks up. So you get that perfect combination to drive the reflation trade, the higher stocks, higher commodities, in that you had growth and valuations rising at the same time. If you look at this slide here, which is a GDP model, one of the ones that we use, doesn't look to us that we're going to get that rebound in the growth story to back up current valuations. So I'm a little concerned that some things have run a little too far ahead of the curve and a little too far of the story in that presumption that we automatically have pulled off a repeat of 2016. So if you look at a chart of equities, and I've just thrown one in here, you'll see that at least superficially, it looks like we're game on. We've pulled it off. Everything's great. We use some internal metrics, which in the next few weeks will signal either a failure or a renewed bull cycle. In which case you sort of get Larry Finks, the chairman of BlackRock, has been talking about the melt up, right? And that's possible. But I think the jury's essentially still out, because at this point, this could be nothing more than arguably a bull trap rally. If you remember, late 2015, stocks start to come off as China devalues. We initially do get a bounce. We get a bounce that goes almost to the prior highs within ticks, which is kind of exactly where we are, and then we fail again. So I think in the next few weeks, we're going to know. We're going to get more data, which is either going to confirm existing data that the recovery is real and it's broadening. A lot of that has to do with what's going on in Asia, not so much in the States. I think really the problems are overseas a little bit. That will have had all the earnings numbers, and that will confirm things as well. So I think, superficially, yes. But there are a couple of things, if you look at some of the other markets, which aren't confirming it. So I've put a chart in here of forward swaps. So this is 2/10s swaps pushed 2 years forward. So it actually moves faster than the metric that a lot of people look at, which is the 3-month, 10-year curve as a metric for where we are in the cycle. And what you can see is this thing based in September of last year. So just heading into the downturn in the equity market. And it got down to levels where it sort of hit in 2000, 2005, 2006. And it is following exactly the same path. It is beginning to steepen That's not a good sign. That is a sign that the bond market is starting to anticipate a recession. And in marked contrast to 2016, where front yields actually collapsed, what you'll notice is basically 2-year yields have hardly moved. So we really haven't had that easing from the bond market. The second thing is I put a chart in here of the dollar, and this is the rate of change of the dollar. So it encapsulates both the acceleration or deceleration of the dollar, and essentially from that rate of change, you can see the level, did it move up or down? 2015, we'd see this very rapid up move in the dollar as the Fed had ended QE, the dollar springs up. It's a trade that Raoul and I had been particularly bullish on for the Macro Insider clients. And this runs all the way into the beginning of 2016. You have this destructive rally by the reserve currency, which is hugely toxic for the rest of the world. China's devaluing, emerging markets are getting thrown under a bus. And then you get Janet Yellen coming out, and she stops hiking, ends all the talk of tightening on a dime. And immediately, all that momentum of the dollar dissipates. And not only does the dollar stop accelerating, but it actually physically drops. It hasn't physically dropped at all this time. And to me, and maybe we'll see that, something that we're going to be tracking very, very closely for our clients in the next few weeks, that's essential to keep the game going. I mean, you cannot have sustainable reflation without a weaker dollar. I mean, the dollar is literally, as the reserve currency, the denominator of global risk assets around the world. Right? You can have an up move in oil a little bit. You can have an up move in some precious metals a little bit. We've just seen in the last week, though, that the failure of the dollar to continue to move at all is causing some problems for things like gold, right? We've come up to levels where we just can't push it any further without that additional stimulus from a weaker dollar. And the same is true of oil. And even that, renowned stock picker aficionado, Jim Cramer, has said, this is a rally that's been driven by technology and energy. And I think, if oil can't break higher, it's going to be difficult to sustain this equity rally. And the only way I can see that oil can break higher at this point is dollar weakness. And it's just a very different kind of macro scenario in terms of growth data. And also when you sort of lift the cover beyond, oh, look, equities are up, and you see some of these divergences, that they're just radically different. Gold has gone up. Well, where's silver and platinum, right? Two metals which are arguably higher beta than gold. Gold did about 30% in early 2016. Silver and platinum both did 50% or more. We haven't seen anywhere near that sort of performance. And so when I look at things, there are just holes. Now, it could change. It's possible that we can keep this game going, but I think it's going to take something more. If you look at it in broad terms over a historic basis, reflationary environments are broadly dollar negative because other countries are doing better and there are greater opportunities in emerging markets in particular. Commodities should do very well, and they are typically high beta plays. Within that, commodity miners should do even better, right? There's a whole strata of, you can pick the more aggressive trade to do that. You're just not seeing that yet. Now, it doesn't mean that it won't happen, but I think, people have jumped the gun. We frequently jump the gun. If you go back and look at a lot of news headlines that you get, for example, around every spring. And I did this recently, you go and look at what CNBC said about Chinese industrial production. And for like the last 5 years in a row, every single March, they've said, hurrah, Chinese industrial production's up, it's all great. Well, Chinese industrial production tends to be quite volatile at this time of the year because Chinese New Year moves. And so you sort of get big activity bursts before Chinese New Year, then a big drop, then a rebound. And you kind of have to average those two things out. We had some great Chinese export numbers recently. But if you look at some other things which tend to lead those Chinese export numbers, they're not nearly as sexy. Ultimately, look, I'm convinced that central banks will do whatever it takes, okay? I don't honestly think that they've got a choice. We'd written to our clients that the choice is between essentially the devil or the deep blue sea. The devil is they fail to act, the economy slips gently into recession, and then we're back into this deflation game. I think certainly in the United States, the Trump administration would rip the Fed apart, and I think they're highly conscious of their independence in that kind of environment. Or the alternative is they reflate. That may not seem a bad option, but and they do have this option, and we've got a chart in here which shows how many times they've kind of punted the cycle as unemployment, and that's the key, has started to lose momentum. And you'll notice on unemployment that peaks tend to be very sharp and bases tend to be more rounded. Once you lose that momentum, and I think Bernanke was quoted for saying that once unemployment rises 0.3 or more from its lows, the cycle's kind of ended because it becomes self-perpetuating on the top side. So they have the option to do that. People ask us, well, why do you call that the deep blue sea? Well, because it's not really a great choice to try and reflate an economy and keep this cycle going when you've already got under 4% unemployment, when you've got inflation at 1.5% to 2% versus 0 in 2016. I mean, it was a no-brainer in 2016, right? Inflation was zip. Now it's 1.5 to 2. Unemployment's below 4. Average hourly earnings are well above 3 versus just above 2 back then. There are risks, right? I mean, there are risks that you propagate the cycle again, particularly if you get the fiscal spending, which people in DC are starting to talk about, this infrastructure spending plan, perhaps driven by, bizarrely enough, both the Democrats with Nancy Pelosi supporting it and the Trump administration supporting it. There are definitive risks that you could catch inflation early, which is kind of exactly what happened in the 1960s, and it becomes embedded in the system relatively quickly. Now, the cynic in me will say that that's part of the end game. They want that inflation to become embedded. They've already teed the bond market up for that in that symmetry of inflation targeting we're now supposed to believe. Trust us, we're the Fed. I'm terribly sorry we've been undershooting inflation for years, but bond market, you should trust us. You should let it overshoot for a while. But sort of, implicit in that commentary is the idea that we really don't want you to drive bond yields up too high to choke off the recovery. But of course, the end game of that is we want to financially repress you. And I think that is ultimately the end game. But it is not a great choice for them. It is embracing potentially structurally higher inflation. Clearly, it conceptually goes against their mandate. And in that sense, it is the deep blue sea. But boy, oh boy, compared to the devil, that deep blue water looks bloody attractive. Right here, right now, we're kind of waiting. I think the next, as I said, few weeks are going to be truly informative in terms of both data and earnings and price action. And it's going to be that interaction, I think, that will decide whether the recovery is for real. So we've given some metrics to the Macro Insider client base, which is just another reason why you should subscribe to the product. But I do think in the next few weeks we're going to get those signals. Do we rip sort of straight from here and it's just off to the races? Here we go, the melt-up trade in US equities. Or do we correct first before we get true central bank easing? Because I think one of the things we've been discussing before we went on air is we don't really have central bank easing. I mean, the expression that I like to use is the Fed is cooing, right? So they're talking like doves, but they're not actually dovish, right? I mean, we still have ongoing quantitative tightening, right? The clue's in the word, tightening, right? Now, admittedly, that's going to slow, and maybe that is enough on its own to start to weaken the dollar, and in which case we can keep this game going. Otherwise, we may have to wait till September, till QT physically ends. I don't think they've got that long. I mean, my biggest fear is they sort of prevaricate a little bit. They look at the data. They don't make their minds up. Let's wait. Let's sit and see which way this goes. We've stepped back. We've got time. I don't think they have time. I I'm very concerned that this is not an economy which functions well in an environment of stability, of non-movement, that things just begin to corrode and slowly start to deteriorate. So we've already seen this sort of flatlining of unemployment, this loss of downward momentum, and historically, as I've just said, that is a dangerous sign. So I think really to ensure the reflation, they need to act. And by that, at the bare minimum, end the cooing, actually deliver dovish results, which means end QT and ideally cut rates. And that way, I think we would ensure the recovery that we all want. That would be great, obviously, for the equity market. It should be bad for the dollar. It should be great for commodity plays. In particular, we've outlined a couple to clients that we think are really cheap at these levels if things continue to go. It's pretty bad news for the bond market, ultimately. We've been tactically long fixed income and remain long fixed income, both for the MI2 clients and for the macro insider clients. We flipped very quickly at the beginning of the year because what we were seeing on the data side. We had been short bonds, we flipped, we went long. We're still long because I still think the data, as I showed you in that slide of GDP, is still deteriorating potentially. But if the reflation gets going, then the lesson of 2016 is pretty damn clear. That ultimately it's the bond market that gets thrown under a bus. It may take some time. I mean, remember, Janet Yellen turned dovish in January of 2016, and it wasn't until July where the bond market based and then got thrown under the bus as yields went from, 1.35% to over 3%. But ultimately that is what will happen, particularly, as I said, you're catching an economy which is arguably, if you do catch it, much more robust and much closer to the limits of capacity than it was in 2016, both in terms of wages, both in terms of inflation, and both in terms of level of unemployment. In many respects, it looks somewhat like 2016, and I think it's certainly explainable why the markets have reacted to the extent that they have, and particularly US equities. But as I said before, once you lift the lid and you start really looking sort of at the weeds and the mechanics of the system, there are some gaping holes. The lack of participation of what should be key reflationary instruments, I think, is a concern. And I think the big missing element is the dollar. To me, if the dollar can roll, and at the moment it's sort of quashed in unbelievably tight volatility, historically incredibly tight volatility, where it isn't necessarily clear which way it breaks. I mean, if the dollar breaks up, guys, just forget it. There is no reflation at all, game over. I think the hope is that it starts to roll. Does it roll now? Do we have to wait for the Fed to end QT in September? I think the jury's out. But I don't think the jury's out in terms of which way this market goes, because I think in the next month, we're going to know. We're going to know from the earnings, we're going to know from the data whether this reflationary trade is sustainable and real, or whether it has to correct first to force these central banks to really go. And if that's the case, well, if either of them the case, you've got very clear trades, to be brutally honest. I just don't think at this point you can say with 100% clarity. You can make a bet, but I don't think it's not an educated bet. It's a flip a coin. And that's not the business that we're in. And that's not how Raoul and I, try and help our clients for either macro insiders or our underlying products really try and make money. We want the odds on our side. And I think at this point, we just don't know quite how the chips are fully stacked up.